Hmm.
Zoe, Zoe, you left.
So get ready.
Okay, I was. He was. Hey, Reed.
I've been sleeping. Do you see it too?
I definitely.
Yeah.
And.
Yeah,
I know. No, that's the matter of the there.
That's your rate.
Why was I hurting? No, it's not my hand, my right hand.
Didn't have made it that far. I think this.
Like. Nobody had like.
Yeah.
No, I think.
Yeah, that was a, so. I think the spread was 6.5. I just. Saying why. And a few years.
So, okay. Here.
Like, I would have given.
Yeah,
3.5,
yeah.
Because.
I got.
Of course, it was 6. So.
Anyway.
And it's could be a shock. To me, to see everything. Like, that's all. That's exactly what I've seen. So if they play like that, they get lost like that.
The veterans.
They're more. Yeah, right. You know, yeah. Yeah. Now they can swing ahead.
However.
The guy said, I. Well,
This is the space. It is cheaper. So I'm thinking. Here. You're getting a little bit better. Still. Very.
Yeah. Yeah. We should.
No, you said- Like.
Joey.
So I need to approve these people. Or whatever.
I'm so fascinated.
I did. But then you'd be like, what do I look for? I think the first half, I don't think that's not the way.
And they'll.
Doing pretty good there, you know.
Here.
That house that you were working on was. Yeah. Yeah.
House is terrible. Something about it. Hold the bullet. Crap and. That's.
The AI newspapers.
Turn it off. Or turn it on automatically. You can. Do they need it? I know.
Thumbs up if you can hear me.
Mike, can you hear us? I think that was you.
Yeah, just gonna pick up the. Take the camera up and down.
Yeah. Yeah. Yeah.
So, there are three people in here. You may want to start. I'm going to start doing it. Anybody that wants to ask questions, have a call it out. They put it in the chat. It's really hard to get into the chat. Never. I don't mean to the chat. You know, rather than put it in the chat. I'm falling.
On your way to wherever. How are you?
Beautiful doggy they have.
Yeah,
They hate it. It might not. They hate it. Yeah. When I go, but.
Show my kids.
I was one brownies. No, he's Ryan's like, it's in Michigan, I'm in Utah. Almost one.
Hey there, friend. How you doing?
Perfect name last year.
No.
That was fun.
Oh,
Well, let's see it.
oh, his mind just, that's my, his name just. I'll find, I think I'll get his name. Yeah.
Really? Jordan just called me and said, Melinda, have you ever said, no, my worst experience?
Never seen poorly manufacturing.
Is that right?
The punch list of the walkthrough was probably 3 pages. Well, they build all their,
Pre-built,
they build it off-site and they bring the walls together and put them in.
right?
So when they put the walls together, they have the windows and everything in it. So all the windows were busted out of it. When they straight away somebody, and then they left the windows just broken and open with all the elements that, yeah. It was pretty. I don't know, I just want to say.
Might be.
There you go. What you go?
That's a good idea. Just a thing.
People, you know what, for the job, they're living in that.
It's always back to the box.
Thank you.
Maybe you don't do it to that level, but. At least you can do it.
I used to run marathons, just to like me.
So wait,
I'm like, oh yeah, good. It's like zero fun.
you have to move around all night. All night.
Cut up and read.
Yeah. We were out till morning and she had a gate in the marathon line. That's what I did. I don't want this.
Now I'd be a bump into the other person. Failed on me.
So I was like an open bag of bread like this.
Nicole and I go way back.
Can everybody hear me online? If you have a question, just wave, just call it out in the middle. I'm gonna try to run this today with like, just stop anytime you want, because I want to make sure everybody gets what they want out of this as much as possible, because I'll get to going too fast and I know too much about certain things and I'll like glaze over something that's real important that I want to make sure everybody understands. I'm gonna just cover a couple quick things before we jump in too deep. Because I just want to make sure, before I refer back to it a lot during the presentation, I want to make sure everybody understands these. Does everybody know what debt to income ratio is? Okay, that's like, they put that in the classes, I'm told, but everybody knows what MI, we call it MI, mortgage insurance is. PITIs, everybody know what that is? 1 month of payment, right? So a lot of the products and programs that we're going to dive into at the latter part, they talk a lot about reserves or PITI, and a lot of them, because they're not what I would call non-agency guidelines, like not Fannie Mae, not Freddie Mac, not FHA, not PA, they follow kind of their own minutia, if you will, and they have a lot of requirements around what they call reserves, okay? So some of them is 3 months, some of them is 6 months, some of them is 12 months, but the idea is the lender trying to offer a product that's a little off kilter and they're trying to mitigate their risk by showing that somebody has money, right? So they're lower than default rate. Okay. So if you need me to cover back through that, just let me know. I'm just gonna open it up. Just wanna hear from you guys real quick. What's the most frustrating thing a lender has ever done on a deal to you? Drop the deal. Drop the deal.
Changed brokerages in the week of settlement, didn't tell anybody in his old company. Or me, or my,
Just left. Didn't stop answering calls. Love that one. Anybody else? I'm sure everybody's got stories. Doesn't say much. Yeah,
or get, conflicting, depending who you talk to in an office, conflicting information.
yeah. That's annoying. It's like, this is the problem, and then the loan officer's like, no, this is the problem. Yeah. All right,
I've had a lender tell the buyer's agent or the seller's agent how much money my buyer really had. Instead of just us having that in like the back pocket.
yeah,
Yeah. But she just ended up asking us for more money because she knew that we had that space.
that's,
It's not illegal off your list.
I mean, they're not bound like a code of ethics like you guys are. It's unethical, for sure. You know what I mean? Like, there's a thing of right and wrong, you know?
Sorry, Andrew, I'm still stuck on it, just to make sure, so the deep, their debt part, does that include child support, credit card, and what part of the credit card, like what all is I get the guaranteed income, but what is?
Yeah,
this
so
guaranteed-
ratio. You know, the funny thing about this nowadays is every product kind of will pick apart different things. There's specific nuances on certain kind of product types and things like,
Product being loan product,
yeah, loan product. So like, for instance, one of the things with FHA financing is like, if you have a buyer and they have what we would call undisclosed debt. What I would deem undisclosed debt is something that's not reporting to credit and they haven't like, say, hey, lender, I have this debt, right? It could be like, you know, like Klarna, which is like, you know, I'm gonna buy this shirt and I'm gonna 12 monthly payments, you know, online, you know, because it was a $300 Gucci shirt or whatever it is, right? They do weird things like that. And you'll see a lot of people will go out and they'll just do like, it's almost like layaway, you know, is what I would say.
yeah.
So it doesn't report your credit and there's usually like, you know, you're paying it over 12 months, 18 months, 24 months. It's a really high interest rate.
Yep.
So the way people can buy a product. So lenders like on certain loan types really look at that hard, you know, for years it was never a thing, but as like debit cards, you know, like if you look at a bank statement nowadays and you look at a bank statement 20 years ago, like the amount of transactions on a bank statement today, like a checking account statement now versus 20 years ago is like, it went from like this to like pages, right?
Yeah.
Just because everybody swipes the card for everything, they don't carry cash. So like, you know, the agencies are, you know, they're looking at that stuff and certain lenders are a little bit more picky with it than others. You know, because the way loans are done, that insurance vehicle that's provided to the lender that says, we're gonna insure the loan, we're gonna call this a deliverable to Fannie Mae and say like, hey, you're insured by us, so that was good. It happens post-closing, right? So for them, it's like, they can look around and be like, well, they might question this, they might question that, and they're like supposed to know what they're gonna question, but they'll pick apart loans after closing all the time. So some lenders are a little bit more overkill on it than others. That's what you'll see.
My final question on that, so a lot of times we'll hear a lot of my clients who are like former students, now first-time home buyers, is
Yeah.
this DTI concept, I'm trying to explain it to them. A lot of times what they'll hear is, you have to pay off these two credit cards. Is that because that, what you just explained is it's almost impossible to identify that variable of, you know, the minimum per month or how much towards your.
No, that stuff is usually on there. You know, what I would say is probably more times than not, it's, you know, maybe they didn't scrub the deal as hard up front as they should have from like a lending standpoint, like that happens a lot. I'm gonna walk you through like an actual income calculation of like what underwriting does. So you can see, and I'm gonna pass a handout out so you have it as like a frame of reference, because I think, you know, it's one thing for me to speak about it all day, every day, because I'm in it, right?
Yeah.
But it's a whole nother thing to like have a visual and see like, oh, they go like this high level on income. So we'll plug along, and I think this will help answer your question. The number one thing that holds up pre-approvals, any guesses?
Buyers actually getting in touch with the lender.
That's probably one of them. Sure. But once they've made that contact and kind of done what they need to do, what do you think it is?
Writing documents.
Once we have them, what do you think it is? Once-
Employment verification.
Can be part of it. Income analysis. Income analysis is the number one thing that holds up pre-approval. That keeps them in, we'll call it loan purgatory the longest, because you can't get all the things. And the reason is people assume income equals qualifying income. Income doesn't always equal qualifying income, because if you look at the different government entities that are out there that do mortgages, and let's just stick to the standard products, the ones everybody knows, FHA, VA, USDA, these different normal products. If you look at the underwriting guideline book for Fannie Mae alone, it's 1,187 pages. Okay, it's 1,187 pages. So just to give you some it's complex, right? Like there's a million ways that they kind of split the atom. The more variable the income, the more reviews needed. Why? Most people who are hourly employees don't work 40 hours continuously, right? I can't tell you how many times we get pay stubs for people and they're like, I'm full-time, I work 40 hours. And you get the pay stub and it's 38 hours, 37 hours, 36 hours, 42 hours, 43 hours. And it just bounces around, right? And in their mind, they're working full-time because some of the time they're hitting less. But underwriting does very specific calculations for it. So how is income quantified? I'm just talking specifically about your hourly folks. Overtime is average. So when they look at overtime, you're looking historically. You're not looking at like, oh, this guy might make this much overtime based on his new hourly rate. They're looking at what you have a track record of making, okay? And when hourly rate at 40 doesn't support with a year-to-date calculation, and I'm going to show you what a year-to-date calculation looks like, underwriter always will move to average that income. So they're going to take and they're going to go back in history. They're not going to use, okay, John Smith, I have a pay stub here that shows that he makes 40 hours this one, but the other one's 36 and a half. They're going to look at the year to date and they're going to say, okay, there's this many months in the year. What should have he made if he made his hourly rate at 40 hours over the amount of months? Okay. That's how they look at it. So I'm going to pass this handout out. We're going to take a deep dive into income. I'm not going to spend a ton of time on this because you can. What'd you say? No interest. Yeah. It's the payment.
They just take whatever you. No, but by how many months they're gonna make the payment.
Sure.
I think.
Did you sign it?
All right, so let me walk you through how this math works. Because it's got all the math. So this is for an hourly employee. We're just going to say for our purposes they work at Kinsley. $33.23 an hour is what they make. At 40 hours, okay, they should, in theory, make that monthly, 57, 59, 86, which annualizes out to that, right? And this situation, as of March 17th, which is when the period ending for the pay stub is, they've made $13,495, right? Which if you take $13,495 and you divide it by 3 months, 17 days, which is a calculation of 2 full calendar months, 0.57, right? They're pacing 52.50 per month.
You okay?
Which is approximately $6,000-7,000 less than what they should be making.
Oh, wow.
Alright. Thank you.
You know? I was like, why are you not talking?
Can't see the screen.
My apologies.
So in 2025, they made 64,321. 2024, they made 63,213, right? So they plug all this in a spreadsheet, the math is done for them, and what they basically will say is you increase your earnings from 24 to 25 by 1.7%, there was a decline from 25 to 26. And really what this is saying is you need to use the year to date because it's lower, right? Who in here has had their income changed on a transaction in the middle of the process and had to have debts paid off as a result of it? And the buyer's calling you freaked out, pissed off, angry. It may not even be a lender you prefer. It may just be your any lender, you know? Overtime, this is where I said they look at history. 2024, they made 13,000. 2025, they made 12,521. Year to date, they're pacing 5432. 2.57 months into the year, right? So if you look at it, year to date, they're saying, oh, you're doing really good. Your overtime's up. But they're gonna look back into history and they're gonna say, well, from 24 and 25, if we average it, that's what you made. In 24, that's what you would have made. And generally speaking, underwriting is gonna take the most conservative number, right? It doesn't mean you can't fight to get 24 and 25, but look at the difference. 1,043 versus 1,118 versus 1,081. I mean, you're fighting over dollar, right? And the income is kind of the income. There's no way they're giving you year to date. It's almost double. Now, the thing you have to realize is if you put this person having 2 other jobs in here, changes everything. Like the minutia of all this changes and how they evaluate changes, the history changes. Why? You know, the more wild buyer is with multiple jobs, the longer it takes to get pre-approved, the longer it takes. If you're actually figuring all this out, they're doing the homework up front, right? Getting employment verifications, getting pay stubs. Really what you need to accurately figure all this information is the pay stub from the end of 2025, the pay stub from the end of 2024, and their year-to-date pay stub. To actually get this calculation done, which is what they're gonna do when a loan actually goes into underwriting. Any questions on this? I just want you guys to see it at a high level, because that's what it looks like day in and day out. Enough about that. That's boring. Financing type matters. We talked about this in the last training I did. What sellers and agents want to see? Cash, conventional, non-QM loans, which we'll talk a little bit about today, follow conventional appraisal standards. So they kind of look at them laterally and the way they're going to be disclosed on a contract that does a conventional loan. Generally speaking, they're not going to be like, well, we're doing a non-QM loan. They're just going to write conventional financing. That's what it is. FHA, VA, USDA, PHFA loans. Now, look, this isn't like my picking. This is just how most agents look at this, right? Most agents will pick that they want a deal that looks like this before a deal that looks like this, right? Let's get into the why a little bit. Also, reno and non-traditional financing. FHA, here's the basics on FHA. 3.5% down. This is going to be, everybody's probably knows most of this. They are the most flexible credit loan. They offer the highest debt to income ratio. And I would say as far as income credit analysis goes, it gives the most flexibility from those standpoints. Downside is it's stricter on property standards. They're very much concerned about health and safety, chipping paint, missing handrails, age of the roof, condition issues can delay or kill deals if you don't set the right expectations. What you should take away from this is more buyers qualify, cleaner homes definitely work best, but be cautious on fixer-uppers, right? That's the basics. This is going to be, again, like I said, a lot of this you guys probably already know. VA, 0 down, no mortgage insurance. They're more forgiving on qualifying. They use what they call a residual income calculation. So VA, it's about the disposable income that the borrower has as much as it is about the debt to income ratio. They almost like qualify two different ways. And I would say the qualifying makes more sense because they look at the amount of people in the household, the square footage of the house. They actually do a maintenance factor on the property to decide how much maintenance the borrower could be in to pay. And, it's a pretty finite way that they calculate it. Appraisal, they look at safe, sound, and sanitary very much like FHA. There is some overlays on, to what FHA requires as far as they want water test if you're on a well, and they do want termites. Some lenders will require septic, but the VA does not require septic unless there's something failed or like something wrong with it. In my opinion, minus the strictness of the appraisal standards, this is probably one of the best loans out there. Like a vet, the interest rates are typically lower than traditional financing. There's no mortgage insurance. If they're a disabled vet, a lot of times they don't have to pay the funding fee depending upon their rating, right? And the ones that are 100% disabled, they can apply for tax exemption, right? So I don't know how many of you know that, but if you're 100% VA disabled, you can apply for property tax exemption on the pay property taxes.
I have a question on that.
Yep.
We have a buyer he's from Georgia and they're moving up here and he was asking about that in PA. Do they have to apply every year?
True on the time frame. For a lender, we're always going to qualify with them because the tax thing is issued after closing and you need documents from the closing, and there is a qualifying piece to you have to be under a certain income
They
threshold.
should work with the lender to do that, not.
They should work with the county, with the Department of Veterans Affairs. Because the Department of Veterans Affairs has like it's like a 2 or 3 page form you got to fill out with a bunch of documents, and a lot of the documents are through the transaction. For a while, I worked for a couple companies who used to like try to do it simultaneous, but what they found is that sometimes they would take a year, 6 months to approve. Right now, they're doing a lot better with them from what I've been told. Let's keep going here. Conventional loans, as little, and I want to speak purely about like agency, like Fannie Mae, Freddie Mac, right? Like the ones that kind of everybody funds to. As little as 3% down for first-time buyers, 5% down for repeat buyers, easier appraisal standards. Long-term cost versus FHA is typically cheaper because you're not paying the private mortgage insurance fees for the life of the loan and the funding fee, which comes into play on FHA. But it's very like credit driven, which is the difference, typically for your more well-qualified buyers. DPAs. We're going to talk a little bit about DPAs. And this is like very like broad overview because there are so many products out there for down payment assistance. And if you want to talk about one specifically or have questions about it, just kind of stop me, okay? So the way that most loans work with down payment assistance products is the down payment assistance vehicle is typically a second mortgage or a second lien behind it, okay? And they typically will pair it with an FHA, a conventional, a VA, a USDA. That's how it works in most instances, okay? Down payment assistance will typically come in 3 forms. Forgivable, meaning like you live in the house for a period of time and they forgive it. PHFA, state agency product, they forgive it 1/10. The one product that they have, they forgive 1/10 year over year over year up to 10 years. At the end of the 10th year, it goes away. Short-term repayment, typically 10 years. Some of them have short-term repayment. We have a product that's like an FHA that has a down payment assistance program. And what they do is there's no income requirement, like no minimum income standard to it. There's no asset standard that you have to meet. You can use it for repeat buyers, but one of the things on it is they give you the DPA, but it's repayable over 10 years. It's a shorter period, right? So the buyer's got to be a little bit more well qualified, in my opinion. And then they do products with full term repayment. Most programs that offer down payment assistance, they come with income limits, right? Because they're subsidized housing program. The government has said, oh, we're going to give you this product, but you got to meet certain subsidies to be able to get it, right? Income limits, asset restrictions. Like one of the big ones for USDA is if you have the amount of 20% down in the bank account, they don't want to do the loan. That's a big one nobody knows. Like they won't do the loan. That's their underwriting guidance on that.
Like if you don't have what?
USDA.
Like if somebody wants to use the no money down loan, USDA loan,
You got 20%.
but you have 20% in the bank and you can afford a conventional loan, they won't lend the money. Yep. And you have to disclose the bank accounts as part of the process, like any and all bank accounts that you have. I mean, I'm not saying people don't, but the spirit of the program, the spirit of what they're looking for is disclosure. You're supposed to disclose it as part of it, and you're gonna sign a document that says, this is what I have, nothing else. It's really the design for it is buyers with limited cash up. Yep.
Is that mainly in PA? What you're talking about?
Well, Maryland has a product too. You know, Maryland's DPAs, you know, I don't know how much, if you do a bunch in Maryland, but
Yeah.
that DPA product. Your trade-off on that product is elevated rates typically. The more of the DPA you get, the higher the rate. On the MMP program, you know the program I'm talking about? Yep.
Yeah.
But look, you know, there's a lot of bank products out there too. I think there's, Maryland has first, what is it, First Bank of Georgia that does
Yeah, they
that money. That's probably one of the, like, free money that you don't have to kind of,
That's there in Baltimore City.
yeah. Yeah, there's
Yes,
some,
ton.
yeah, there's some subsector, like, kind of free money grants, but you really, it's like in a box like this with most of them. So my opinion is like great for first time buyers with good income, but low savings, buyers who need help covering closing costs. What you want to watch out for with a lot of these programs is some of the products have higher interest rates than if you just did it without the down payment assistance loan. Like I've seen this a lot where it's like somebody comes in for traditional FHA and well, maybe today their rate's 5.875, but if they want to do an FHA loan with down payment assistance, it may be 6.5. So you got to really look at it and kind of try to educate your people, because I think everybody comes into this. I mean, a lot of the questions I get from first time home buyers are all very consistent. Is like, well, I'm a first time home buyer. What do I get? You know, like they're looking for like that special thing, right? And I mean, I think there's programs and products out there, but it's also like you have to understand the smoke and the mirrors of some of these products. A lot of these lenders will do these products to offer it, but they're gonna make it up. And the way that they're gonna make up that down payment assistance money is we're gonna charge you a higher interest rates, we're gonna make more of a premium, but yeah, we'll give you the down payment assistance loan. So like, you know, your job is to try to be a good educator, you know, but just kind of keep that in mind as you're kind of overseeing that piece of it, because a lot of times a loan officer will give a product, give a program, and not really talk about the whys. Like I can't tell you how many times we've had people come in and they're looking for, you know, they may have 200,000 in a retirement account, right? They can liquidate up to 50,000 and they want to take, you know, and look at down payment assistance loans. And I'm like, man, just take 10,000 from your retirement and you get a better rate on the first by 0.75%. So a lot of that, it's kind of like light bulb goes off and they're like, they don't want to pay more interest on the lion's share of the money to get a little loan that's 10 grand or 12 grand to get them in the house, right? Plus, it makes your job harder right now, especially, right? Like you talk about the market that we're in. I mean, who's had FHA deals fall apart over conditions? Sure, by a show of hands, who's had one fall apart over conditions? I mean, look at just like an FHA or VA deal. And I'll open it up for people to talk about this a little bit because I think it's a good time to kind of pause. You know, they're harder to get accepted than a conventional deal, right? Like right now, especially with multiple offer situations. Feel free to share, like, what do you guys think are some ways you can engineer contracts to like mitigate your buyer's risk to like help them get an accepted deal when they're competing against 3 or 4 other conventional offers? Like, what do you do? Anybody?
Time frame. Ask the seller's agent if they'll be willing to share what the time frame is that the seller wants.
What's important?
Yeah, long, short, whatever, be flexible.
Yeah.
Well, I have a question. If you have a buyer that has to do an inspection.
Yep.
And it's a condition of financing, do you have to elect the inspection?
It's a little more question.
I know.
Not an Andrew question.
Does anybody do that?
I would say you could both.
Yeah,
Like,
because maybe you have an agent that doesn't.
I mean, I see deals all the time where people are like, oh, here's a conventional deal and they won't disclose the PHFA aspect.
Yes,
Like,
why wouldn't do that?
I mean, that's,
But if it's a
that-
condition of the
That
finance,
does happen.
I mean, I'm kind of with you. I think it's hard time right now, right? So like, I've seen agents, right, where they'll like, those FHA deals, they'll like make the deposit non-refundable if the buyer doesn't fall through. Seen that. I've seen, and I'm not saying that's right or wrong, but they'll just, they want to show that, if we break deal, you're gonna keep this $2,500 or whatever the EMD is as a way to make our offer with FHA look more attractive. Or they'll put in there, my buyer will cover repairs through said contractor up to X dollars. I've seen that stuff. Anybody else have anything that they've done to shore up their FHA VA deals?
We just took listing I had, we had 2 conventional offers and 1 FHA. We ended up taking the FHA because it was a lot cleaner, like they didn't want their inspections,
Mm-hmm.
stuff like that.
And the house was in
Yeah, like it was,
clean,
wouldn't be an issue.
minor stuff if anything comes up, kind of, yeah. So things,
I've had some buyers that were FHA and they assumed that because it's FHA, they're doing, that they will do, FHA will do the inspection. And I've had to talk them through that.
yeah,
Like, wait a minute, you should, if you're concerned about something, do the inspection. FHA will look at certain things, but that's not everything.
I mean, I've had people get sued over things like that. I know of, not myself, but like agents that have been involved in transactions. Because they're like, oh, FHA does their inspection. It's like a play on words. It's like, it's not an inspection, it's an appraisal,
In my current one, I said my buyers would do the work. They came back in the appraisal. The only thing that came back was a handicap. Made very.
You can put a dollar figure cap on that, like how do you protect the client? You know what I mean? Like, that's the tough part.
I had one where it came back for peeling paint on a brick wall. And
They painted half of it before?
my client, my buyer opted to pay and do the work himself. And it was an agent that was in the office here and he said, okay, well, we did all that
Some
before.
people say that style with
Yeah.
chipping paint.
Yes, absolutely.
What are they? There's a word.
Chevy Chief.
Oh,
I think sometimes FHA and VA buyers, when we are looking at houses that need a lot of work and we're looking at the chipping paint and all that stuff, I think they think we're just trying to snow them. But I'm like, no.
yeah.
They're just they get upset. They're like, well, I really want this house. I'm like, well, but it's not gonna pass your grade.
Yeah. I think it's hard because you're trying to you're setting expectations so they have a successful transaction with making them happy.
Yeah.
It's a hard job, that piece of it's very tough.
Do you do anything with, NACA?
I do not. That's a tough product.
It's not. Why do you say it's tough?
Just the reviews and feedback from their website that I've seen, it's from what I can tell, it's inconsistent from an underwriting. That's the feedback that I've gotten on it. I'm gonna keep going. So what to watch for with these? Higher interest rates versus standard financing. Just make sure you're kind of looking it over for your clients, right? That's what I would say. Like if a DPA is coming in and it's like, oh, the DPA interest rate's 6.375, but last time you looked at an estimate, it was a lot lower. It's probably worth the conversation so they know, because they're going to pay on that mortgage for a long time. Tighter property restrictions, right? Longer closing timelines. A lot of these government agencies, right? You look at specifically PHFA, and I think PHSA has really got it together right now. But sometimes they'll get, as you get into summer and people start to take vacations, a lot of their staff's out of office and they run up really managed time off, not like a privatized institution. They manage time off like government. So if 10 people want to take off because graduations are happening, they just let them off, right? So you'll see underwriting timeframes go from 5 days to 25 days in June a lot of times. It's just something to be aware of and make sure that people understand. That second underwrite piece is a big one. And they're definitely more picky on credit histories. The other thing is clawbacks on the DPA. This is one that you guys don't get to see a lot of times, but I see it a lot. So you'll put somebody in a down payment assistance program like a PHFA. PHFA has that one program where the loan is forgivable year over year for 10 years, right? Everybody wants to refinance right now. So you put them in, they're thinking, oh, it's free money, right? Making that, you're just trying to get someone in a house, and then they're upset when they gotta pay it off to do the refinance. Because they thought it was free money, they didn't read the fine print. So just keep that in mind. Because that can make, if you referred the lender, sometimes people can come back and be like, they put me this weird product, I had all this extra money, they said it was free, it's not free, like they look at you,
So if you refinance before the 10 years, you gotta pay it back.
Yeah, it's forgivable 1/10 year over year for 10 years.
Yeah.
The PHFA, I think it's KFIT is what it is.
Yeah.
K-Fit.
Yep.
That's what I have.
Oh, K-Flex.
Yep.
K-Flex, I think, is a loan. I have to look, I don't remember off the top of my head.
Yeah.
I think you guys know.
Yeah, I have K.
1/10 year over year. USDA. Some interesting stuff about USDA is changing right now. They're 0% down. It's designated for rural and suburban areas. If you've never looked up our eligibility maps, it's all online. You can search what's eligible, what's not. It's lower MI than FHA. They're moving towards delegated lender underwriting, which means it's not going to USDA anymore. That should, I think you'll see that in the next 6 months, but the guidelines are tightening at the same time because they're trying to rein it in even more. They want less flexibility on borderline files is kind of what's come out of it. So it's going to be tighter on underwriting. That's what I can expect. You're going to take a product that's already very tight on underwriting and make it tighter.
But you can close them a lot quicker, right?
60?
30,
Once they delegate, it'll be a little than that.
right? I mean, 45 days is like 45 to 60. I mean,
Yeah, I would say 45
They were
to
like
60 on
45 to 60, and
Yeah.
it's just like PHFA. It's the time of year, right? It's like that time of year thing. Like, what time of year is it? Like, you get on a deal in like November and December with them, and a lot of times it's like
60.
everybody's off.
if the lender's doing it, you're not sending it to USDA, are you thinking 30?
I'm thinking you're probably a 30-day deal on it. I think that this will. I think what you're going to see is like it's going to be a lot tighter on underwriting.
Because that's, USDA is the biggest holdup. It's such a.
It is, and that's why people don't want to do the deals.
Yeah.
But I think it's going to be a narrower box because they've ratcheted down the qualifying. I was talking to the head of our underwriting about this last week when they announced it. And she's basically like, yes, but they've ratcheted underwriting down and they're going to continue to ratchet it down until they find that easy medium. So I think your box of people that qualifies is like kind of like this already, and it's going to be like more like this.
And what about the property? Is that gonna
It's going to still be the same stuff.
be tight as well?
I think they're just going to follow HUD rules, which they've always followed,
That 20% thing, I'm stuck on that still, so. So if they have a lot of cash, they're.
Yeah, they're not-
That's my point. If we know the client has a lot of cash,
Won't even mention,
you would or would not?
would not. Let the lender kind of talk that. I mean, I think, look, everybody's got a different way that they do things in a system and a process. And I think if you're a perfectionist like me, you're just always trying to improve it, fix it, and make it better and like get better and adapt to the things that kind of come up. You know what I mean? But that's your decision, you want to tackle that or not, Property condition requirements. All right.
Thank you.
I'll send this to you. Just email me. You have the whole thing. All right, so we're gonna talk in non-QM loans. What is non-QM? Loans that don't follow traditional agency rules, Fannie Mae, Freddie Mac, FHA, VA. What I will tell you is that this has probably been around for about 4 or 5 years, non-QM products. What I have found is that most loan officers do not do it because they don't understand it. There are some that do it, I think more now than ever, but you're really looking at like these products is, let's just say there's a dozen investors who dabble in them, right? They all have different guidelines, just like Fannie Mae, FHA, VA, and USDA. So you really gotta kind of, every time we have one, we're looking up the guidelines to kind of like make sure they fit, right? Because everybody's got some weirdness about them. Why it matters, helps clients who don't fit the box, opens doors for self-employed and investors, turns declines into approvals, common solutions, bank statement loans. This is a big one for the self-employed. Okay, we're gonna take a deep dive into that. DSCR, which is for investors. Most people have probably heard about this. There's a lot of info in there about just floating around about it. Asset depletion. We'll talk about what asset depletion is. 1099 loans where they don't look at tax returns, which is great for realtors actually. Interest only options. Key trade-offs, higher rates than traditional financing. All right. But I'm not talking like crazy higher rates, like you're probably anywhere from like 1/2 to 3/4 of a point. Some days on those DSCR products, which are specifically for investors, you'll price those out and they'll be 1/4, 1/2 of a point within regular traditional investment property loans. You know, and you're not having to verify income. They just look at the property. Some of them have prepayment penalties. That's something you guys probably don't experience much, right? We'll talk a little bit about prepayment penalties. So bank statement loans, income is based on the average of the deposits over 12 or 24 months. So we'll take one bank account generally, some of them will look at two, but mostly they'll take one bank account for that business and they'll add up all the deposits over 12 months. Throw out the ones that are like weird. Let's say they sold a house or something, it's a flipper, and they have like one crazy deposit that's like doesn't happen any of the rest of the year. Sometimes they may throw that out. If you can verify why it's consistent, they'll put it back in. But what they'll do is they'll take those deposits and they'll average them over a 12-month span. Right? Typically, it's 50% of the deposits because they figure you're going to have some level of expense. So if you have a business and let's say the deposits coming in are averaging 100,000, right? That means they'll give you 50K in qualifying income. So this fills a major void for those folks who cook their tax returns, right? And you can do this on all occupancy types. Primary, I think most of them will start 10 to 15. The investment stuff starts 20. Reserves and asset requirements for these, a lot of them it's 6 to 12 months of assets, right? So 6 months of that PITI in reserve. So if mortgage payment's $2,000 and they want 6 months, do the math. If it's 12 months, do the math, right? It's pretty easy. Great for people with cooked tax returns, like I said.
Service industry folks,
What is cooked?
service industry, waitresses.
You cook the books of your
bartenders.
tax return, you like make 150,000, but you say you made like 10. To the IRS, you don't have to pay taxes.
You rate everything up.
You stretch your mind a little bit. You want to,
You follow the book. So as a lender that looks at this all day, if I had to say like, hey, if I look at 50 sets of tax returns, none of them are consistent. You'll have people, I'll get a tax return once in a while and they'll claim every penny that they make. And then you'll get probably most of them claim about 40 to 30% of what they make, right? And they'll cook the rest with expenses. Some of them it's half, some of them it's 3/4, but it's more often than not, people do not. You sit in my office for a week and look at tax returns, you'd be like, ooh.
I actually just closed the deal with a big statement in summertime.
Yeah.
There wasn't a lot of lenders that do them.
Probably is a lot to do them, probably just not that don't. You know what I mean?
Yeah, I used some guy from California.
The 1099 loans, let's talk through these. Any questions before I keep going?
just a quick follow, was that a better option for the service people, the waitresses, the bartenders, in the look, I guess?
So a service person, no, because they're a wager, right?
Is there a more gross estimate, like where loan programs that seem to work out more so for those people in the service industry?
it really comes down to them needing to claim more because they're a W two.
Yes,
It's
like-
it's kind of a tough, that's still one of those tough products they don't really have.
Some
Something
waiters, waitresses.
Yeah. But I think what I've found with wait staff now versus wait staff 20 years ago because of credit cards, there's more claim tips now than ever because everybody swipes. And they have to put it on there. Because it's track record.
Most of them don't make, they don't even make average of, I mean, the establishments don't pay, minimum wage. They earn a lot.
283, what is
Yeah.
that? I think
It was 234
Okay.
when I used to be a server.
So they expect you to make up the rest in tips, right?
Yeah.
Does that happen?
Yeah.
Oh, good, wait,
I got a bar, so.
But for like, so what about for like people who do DoorDash and Uber and
1099.
1099.
so they are.
We're gonna talk about that. So this product, which is a 1099 product.
Mm.
And this is a good product for real. They use the gross of the 1099 income over a 24-month period. And they deduct the 25 to 35 expense factor depending upon
I gotta do.
the lending entity, right? So if you make 100 grand, they're gonna chop 35% of that off, and that's your income. You can pair this with a wage earner, so like if one person's 1099 and one person's W2, one person qualifies traditionally, one person qualifies under 10. What they do on these is they confirm that the 1099s have been filed with the IRS. So if you come to me in 2025 and say, here's my 1099, but you work for some mom and pop shop and they haven't filed the 1099 with the IRS, they're gonna pull a transcript on it to make sure that what they've given is what's filed. It's not filed, you're gonna have a problem. So it's like weird things like that with it, but you get people in loans all the time with these kind of products.
What about 1099 and self-employed together?
Yep.
Okay.
Yeah, we just qualify them under a traditional way. These products are 10 to 20% down. Again, it works for people with those cook tax returns, and there's, again, same thing, reserve requirements. Anybody have self-employed deals that blow up mid-process? Raise your hand, ever. Because somebody didn't look at tax returns? Or do you feel like you've had deals that like probably maybe could have gotten a loan, but said they couldn't get a loan? Because of tax returns?
You do want to pick up at any time.
It was on the edge.
Yeah, that was. Yeah.
Like one, he easily made 750, but it was a family business. And his lender was concerned that they might have a problem with it being a family owned business.
Yep. So there's actually like unilaterally, the agencies, like if you talk about like a traditional, even just a Fannie, Freddie, FHA, each agency has a totally different set of guidelines if you work for family.
Yeah.
They look at totally different qualifying income. So, you know, I had one, this was last summer, this is a deal that we closed, but the girl was stay-at-home mom, and then she went to work for a family. She didn't have tax returns, and one of the prerequisites for Fannie and Freddie is that they want to see tax returns. Because they want to prove that we didn't just put you in the workforce and give you paycheck stubs for 3 months. Right? So couldn't use her income, we use her husband's income, he had been there and had the tax returns and they qualified, but there's. The agencies have specific guidelines for it, and a lot of these products, you know, they have stuff in their in the finite detail of their guidelines about the same thing. And sometimes they just don't care. Like I've seen them on these, what they'll call these non-QM products. Sometimes you'll just get exceptions, like they'll accept certain things. It's like, we like the loan, we don't care. You know, they have a bunch of money, like we'll just do it. It's like really easy, a lot easier to get an exception on than like a traditional loan. 'Cause it's, you know,
What's the expense factor?
expense factor is like, so think about it, if you make, let's say you as a realtor go out and make $75,000 next year, right? What they're gonna do for your qualifying income is they're gonna say, we're chopping 35% of that off. And that's what we're gonna say you actually made because you have expenses. Maybe it's realtor dues, maybe it's marketing, maybe it's gas, whatever it is, right? But they just automatically put that in.
But wouldn't that be bad?
It is, but if you have a tax return that doesn't show any income, what's your alternative? You're giving a vehicle to somebody for possible homeownership that has no option because they didn't, I mean, they wrote off too much of their taxes, generally speaking. You're looking at this as like a plan B because they didn't qualify traditionally. That makes sense?
Okay.
All right, asset depletion. This loan is great for your retired folks, right? People who are retired and have a ton of assets, but maybe aren't drawing on their assets, okay? So they'll take the assets they have, and let's just say you have somebody that's got $700,000 in assets or $600,000 in assets, right? But they don't want to buy the house in cash. They want to finance, right? So they'll take those assets, divide them over 60 months. Some lenders, it's more, maybe it's 72 months, maybe it's 80 months, whatever it is. And that's their qualifying income. So they're just looking to make sure that they can sustain payment for a period of time, right? No employment's needed. It's great for retirees with high net worth who are maybe they're just drawing Social Security, but they don't make enough to buy the house, right? Maybe they're not drawing on those retirement assets yet. What you got to watch out for is age restriction, right? So if maybe they have a 401k that they're trying to use, but like they're not at the age that they can take distribution. Like that's the things you have to look out for. That's kind of your curveballs in this product. This is not something you're going to run into every day, but it's a good product for the right person. It's best for people who have assets who haven't started drawing on them. DSCR loans. This is specifically for investment properties. The income is based on the rent. Okay, so basically what they're looking at, most of these products will qualify off of a 1-to-1 or 1-to-1.25 ratio, which means your rent has to outpace your mortgage payment by either 1.25% or it has to be equal to. Okay. They typically want to see 20 or 25% down. They do allow you to invest as an LLC. Okay. There's typically asset requirements, generally 6 months of mortgage payments or 12 months of mortgage payments, right? The advantage of this product is it's typically 30-year fixed money. Most bank alternatives, and not all of them, but a lot of the banks, what they'll do on the investment side of things for clients is they'll put them on a 20 or 25-year amortization, which typically balloons at 5 years, like a lot of the bank products that are kind of equal to this. What it does for the bank is they're constantly having to refi and they're starting over paying interest, right? So if you own that property as a long-term rental, you're refining it every 5 years. Because you're on a balloon, right? The advantage of this 30-year fixed money. Rate doesn't change, payment doesn't change. This is a thing that we look at for a lot of people right now. And I would say all things being kind of equal, like if you look at what traditional investment property rates are, it's usually an 1/8, 3/8, 0.5% higher, not much more right now. So it's very close to what traditional Fannie Mae and Freddie Mac, like a traditional conventional financing interest rate would be. Questions on this? Anybody using this now? What's their clients?
What's the closing time for myself?
30 days.
We have to them.
Yeah.
They're easy. I mean, I had trouble myself with the appraisal for one, just not knowing where it needed to, but then I had a purchase on one of our properties where the buyer used DSCR loans and it was really easy. I mean, it was quick. It was super easy.
We did that one.
Yeah.
20 something.
The only thing you have to worry about is making sure the rent.
Yeah, it's the rent.
Yeah.
Have a conversation with the appraiser.
So is it?
Full rental comps if you want beforehand, send them to them. Yep, they look at market value rents. Appraisers estimate a fair market value rent.
Isn't it a little bit for that appraisal?
Yeah, so it's typical appraisals. $525, $550 these days, depending upon who's doing it, right? And you're gonna pay, an extra $250 for rent schedule, sometimes $150, somewhere in that range. I would say it's anywhere from $600 to $800, somewhere in that realm.
Your asset requirement, that's just you owning.
What's that?
I said the asset requirement is the primary residence.
It's invested for investment only.
Oh,
Yeah.
well, what's the asset requirement?
Asset requirements usually 6 to 12 months worth of mortgage payments are reserved. Yeah, but they get like the credit stuff on this. I think you can do them 660, 680 kind of
Yeah,
thing.
some of-
Some of them will even go lower than that, but you get booked on the rate when you get into those low credit profile.
That's all one for like 560. Yeah. Now it's like,
Like LTV.
I was like, what?
It's like these loans, if you've been doing this long enough, they kind of remind me of like subprime a little bit, a lot of them,
Little bit.
Bridge loans. Bridge loans allow you to use the equity from your current home. Allows them to buy before selling. Removes the home contingency, assuming they can qualify. Stronger offer, more competitive. Does come with a little higher costs. So most lenders know that bridge loan is short-term financing. So some of them will charge points, which means you come in, let's say you get a bridge loan, let's say you already have a first mortgage. Maybe they want to put a bridge loan on the house for 200 grand or something like that. Just to get you the money to be able to purchase the other property you're interested in. A lot of times that bridge loan will be set up with, hey, it's tied to prime +1, and prime +1 plus 1 point or 2 points or whatever it is. Because the bank doesn't make money and interest on it. So it's the only way they can kind of mitigate the cost to do it is by charging money up front, generally speaking. In my opinion, it's a great tool, but it's really for a narrow amount of people that you're going to use it. Typically, if you qualify for the bridge loan, a recast is also a good option. That's usually what I'll kind of lead with because you're only, you're not paying money to do a recast. We'll take a little bit of a dive into what a recast is. All right, so I'm just going to run through max debt to income ratio standards by loan type, just so you guys have something. And this is with like AUS approval and strong credit. You get into the weaker credit profiles, and it's not always going to be what this looks like. Conventional, 50%. Fannie Mae and Freddie Mac really limit you to 50%. FHA, you can get up to as high as 56.99% on the back end.
It's crazy.
But that's got to be like stronger credit. And I would say stronger credit on FHA is like 670, 660. Doesn't have to be like super duper vanilla to get that. VA, 50% plus or minus, but I've seen VA loans go up to as high as 75% DTI if they have strong residual income. Meaning if they have a lot of leftover cash, don't have a lot of expenses, don't have a lot of debt.
Andrew, please don't hate me for this, but in general, have these numbers escalated? Did they used to be
Yeah.
30?
Yeah, they did.
30?
So look, what they teach, right? And is what the traditional standard was.
Yeah.
Our rule, and to be clear, on the standard GSE products, Fannie Mae, Freddie Mac, FHA, right? I'm gonna write this in.
Way different.
Okay.
Yeah.
FHA, VA, USDA. Fannie, which would be any of your conventionals, right? Freddie. All these products live and die based on automated underwriting. Means a computer makes that decision. But here's the deal, right? It's based on the integrity of the data that we put into it. But you can get a false approval if you have a lender who doesn't do all their work up front, doesn't do this, right? And they just throw income in there. They're like, oh, they work hourly at 40 hours at this hourly rate. Here's your approval. Well, we got them approved to 55 debt to income ratio for an FHA loan, and underwriting gets it, and they're like, well, you didn't do a calculation, like you didn't look at it. Here's your actual income. Oh, you don't qualify, or you got to pay off 6 debts. right? Automated underwriting for me is one of the best vehicles we have, because if you do the homework up front, I can pretty much tell you if this was gonna qualify. It's like artificial intelligence for the lender that says, taking it or we're not taking it. 90, I would say probably 95% of FHA loans are automated approvals. VA, probably 80, 85. Okay. USDA, I would say it's probably 75, 25. It's probably like 98% for Fannie and Freddie. You're not getting through AUS, you're not getting a loan. I don't even know, I mean, I think the people that are doing those Fannie, Freddie manual underwrites are like Wells Fargo, like your big banks, like they make a shelf it and hold it.
So when we hear lenders say, oh, we've already run them through our pre-underwriting, then that means they've already done this.
Yeah.
And so
But
that
it
means
goes back
confidence
to,
of
it
time.
goes back to, did they do this?
Yeah.
You with me? How detailed are they? Like if you talk to them at 2 o'clock, they're giving you approval at 3 o'clock.
They didn't do this.
Well, what you tell us, it's already been through underwriting though. Don't I have to assume?
Automated underwriting,
Huh?
real underwriting and automated underwriting. So here's real underwriting is. Real underwriting is somebody taking all the actual data and looking at it and saying, this is, we're with you, this is what we believe. They're reconciling, correct?
Like,
They're the checks and balances. It's the non-interested party. It's the person who gets paid, whether the transaction closes or doesn't close. Make sure that like this works, this doesn't. This is why who you work with
Matter.
really matters. You know what I'm saying?
If
It
you,
doesn't have to be me. You know what I'm saying?
if somebody tells you they're pre-approved and they haven't turned in their documents, like,
It's the bullshit.
that's red flag.
Yeah.
So then what's the question to ask if the lender's gone through this right here, automated? What you're saying?
I would bet 90% of my peers.
Don't do this first.
that happens with responsible people.
We don't have this. It's qualifying here. Here's your.
Are you using pre-approval? That are changeable, that is way deeper than a pre-approval.
I mean, that's our standard process. You're going through automated underwriting, pre-approval with me. That's the part.
That's not everybody's, though, right?
So, some of them will at least run through if it's like questionable,
Okay.
you know? I can probably tell you on these right here, I could probably tell you on 85% of the loans I look at, if they'll go through this and this. Without running them. Just from like doing loan for a long
Yeah,
time.
yeah.
But not every loan officer is that good and has made like, you know, if you don't touch enough, it's all on how many you touch.
I totally understand.
It's all on how many reps you have. When you have more reps, you're looking at more loans, you have a better feel for what the system will take, you know?
Yeah, in general, I guess my question was, that percentage is more alarming, just looking at it from a typical homeowner point, like the street is getting way and way farther out of reach. 20% of me.
So what you guys are saying, what they teach in real estate school, 56.99. But we've been approving loans up to that DTI, I think, if we can get them there for a long time. You know, if that hasn't changed. What they do is they'll go in, they'll tweak the automated underwriting system. They don't tell anybody what tweaks they're making. They'll tweak it in the back end, and then you're running loans through and, you know, they stick you to a version. So once you've run it through, that loan is kind of grandfathered unless you have to run a new credit report. Okay? They'll make the tweaks and then when you run the loan through, maybe that one doesn't qualify, this one does qualify. That's how they can kind of control it without telling us too much information. With me? So USDA 4145. I mean, you gotta have a pretty vanilla USDA to get a 45 back end approved with them. Non-QM is typically 45 to 50. Your DPAs, like just looking at like even what PHFA does, I would say 50% on like your government stuff and conventional, they kind of hard stop you at 45, you know? Appraisal standards, I'm gonna hand you out. When we were at this last class I had, you made a good point about there not being like a good handout, so I jazzed this up a little bit. And this goes over appraisal standards for FHA, VA, and conventional.
I was an asshole, sorry.
No, I was appreciative of it, because you're right, nobody has a good document, you know what I mean?
How they do.
Wow.
You might have to have glasses to look at it, but it's got a lot of stuff. So really, I just broke this down into like what kind of conventional it's for. And then your FHAs being a little bit more strict, and then VA, they really just add on termite and water, you know, on top of it. But if you're meeting with a buyer and you're trying to like explain to them why an FHA doesn't work, defer to the lender, let it be the lender's fault,
Right.
right?
Because why
Make it
believe
my
it?
fault.
I believe it.
No, they want to call, like, they'll send me a property, I'm like, sorry, it's only cash conversion, they get all bent up.
Okay. They hate you because you're
Yeah.
gonna tell them no.
I have to tell them, yeah.
Nobody wants to be told no. All right, recasting. This is where they apply a lump sum to the loan after closing, lowers the monthly payment, they keep the same interest rate. No refinance necessary. This is what I typically will lead with if somebody wants to buy and they have to get an offer in quickly because the house is hotter than hot, there's multiple offers. And they want to sell, and we're trying not to hold up the sale. You know, we'll typically lead with recasting after selling a home, they can apply the proceeds back. I think they have to use at least 10 grand, but who the heck would want to do this for less than that anyway? I want to say we don't charge for this. Last company I worked for, we charged like $500 or $600 for it. And it basically just allows them to restructure that loan with that amount of money down from the beginning.
What's the time frame? Like after settlement, like that you can redo this?
Pretty unlimited, you know?
Really?
Yep, they have not told me that there's a specific cap.
Is there amount of times you can recast?
I get once, yeah. Good question though. I can ask. You know. I mean, you get an inheritance.
Yeah.
Right.
You hate your mortgage payment, you're struggling, it's like. You don't want to pay it off, but you don't want the high payment, you don't want to spend money to refi because you got 3%.
Right.
I mean, look, the other thing you can do, like with those contingent deals, you can get a line of credit too. Line of credit is probably the cheapest way, but even the line of credits, a lot of these banks don't want to make the line of credit once they find out what you're doing with it. You can't help. But what they do is they do a clawback on probably a month or 2 months worth of interest to kind of, so like, I don't know, it just depends on the customer and what you feel is right for the customer. We did just bring on this other bridge product. It's called NOT, which allows you to actually fully not count the payment of their primary mortgage if they qualify for it. But it is expensive. Like you're paying these people that are gonna make this bridge loan to you 2 or 3% in costs. You know, obviously, then you got to sell the house, you're paying your agent, and you got your costs on your buy too, so you're just getting whacked the whole way around, you know? If I'm an agent and I'm talking with people who you know are like kind of that window shopper every 6 months, every 12 months, they pop up and want to see a house and they never do the pre-approval, right? Get that person a line of credit. Go get them to get a line of credit. Get it in place, you know? God forbid, right? Like, they don't use it, you're not paying any interest on it, right? You're not paying any fees on it, but if they have that line of credit, they can do a deal a little bit easier, in my opinion. Prepayment penalties. The fee for paying off the mortgage early. This is very common in non-QM and investor DSCRs. Typically, it's structured as a 1 to 5 year prepayment penalty, declining penalty over time. The trade-off for this is they will typically give you a lower interest rate if you do a prepayment penalty. As much as This is kind of the range of rate, and the reason for that is because they're guaranteed money. So in Pennsylvania, they got some weird laws. You can't do them for loans under 319,000, so it will kind of takes it out of the mix for a lot of our people, especially on investment properties. It's basically it. Structure to win deals. Questions for me?
Well, thank you.
Yeah, thanks.
Just gratitude. I just not wonder, it's nice working with you when you have people that are so questionable. Or you don't know whether they're telling you all the truth, you don't know. I love that we can call you and tell you and you take it from them.
Try to suss it out.
Yeah. It's easier for me.
Oh, yeah.
Instead of trying to sit, listen to all this and go. I gotta go in
You're saying that prepayment is under 319 or whatever.
Yep.
That counts for the DSCR loan?
If you go above 319, then you can charge a prepaid. Below you
Right, but below you can't.
Weird law. Do you have one that did?
I feel like I did, that's why it sticks out.
They're not supposed to.
Okay.
But what happens is these investors operate in 50 states. And they do not know the law, so they may just get it. Now unknowingly,
Okay.
I mean, they're probably not in RICO for crushing less, but the person probably got a lower rate.
Right, yeah.
It's kind of a good trade-off. Like a lot of the investment deals, if you're buying and holding, if you're looking at cash flow, like you're very, yeah, you're very rarely gonna use a prepay on something that you're not gonna hold anyway. So it's like in my mind, unless you think rates are dumping 2%, like take the prepay, you know? That's my thought on it. Cheaper money.
If you don't hold your loan for 30 years and you sell before then, is that considered a prepay?
No, just meaning the prepay that they give you.
Oh.
Prepay.
Well, that's good for me. I want to go do something fun.
Question. So you're gonna start doing open houses again? Did you get any marketing materials made yet? Is your,
So it's like hit or miss. Friday.
Yeah.
Whenever I'm on the bottom pit. Would it be okay if I get in here?
Payment synopsis. Crap.
I don't have a house. Okay.
Screw the weather. Down must be like your Bob.
Was getting to look. One thing that I really liked is you had the breakdown process. That was one thing. Carly and I just made stuff.
Whatever's going on.
What? The road. The daughter is the meanest person on today's paper. I love it too. Would your parent tell you to stop using that picture because it doesn't look like him? My daughter literally, my daughter sent me a message through Instagram last night, and it literally says, "This is from my." I can't find it. She sent me a message last night and said, "Stop using this picture. It doesn't look like you." I'm like, my daughter is the meanest person.
Did we ever find
the truth about something? I can't even tell you. Stop using. These don't even look like you two. Just look at you two. It's like me. I mean, it's just like me 20 years ago. Yeah.
You know what I found was the more times I.
Just started.
Yeah.
Then you get a better. You got a square one.
Yeah.
You have any? Well, I promise you. Okay, I'm not going.
I'm gonna drive past it like I'm like. I'm not going anywhere this weekend.
Yeah. You know.
Great.
I gave them.
You know, we have painting that has to be done. They are. I'll let you know.
I'm gonna have to start putting people.
Kathy and I are like, why didn't you say that?
Whatever you wanna do. Because they say all the people that live there too. Yeah. There's a park in there.
Is that?
You don't know what the price is.
She said she's been sick, you know, 6 months ago. Yeah, but she- I told her, like, you need to know, like, I mean, you can always refine the flag in the hands of her change because I can't see it's not going to think about it. If they ever take consideration of some people's. Yeah, I did.
Yeah. And it's like, I'm timing it. It's like, there's something left in my gas tank. Those pops are going yesterday, all the stuff, they, and they're. And then. When you have to hit it in there. Because it says, okay,
She only has a signed affidavit from the court saying that you guys here, so you're, that does not mean you can't.
No.
That's the
I mean, I was trying to just give like the high level overview, which is like, you can really get into these. I don't know.
Good, oh, yeah. Thank you for lunch again. For lunch.
This is between you and I. I'm done as far as that is concerned. I'm not giving advice anymore. She doesn't take it, even though I've explained. I've taken the training. I have people that I know who've been. She doesn't want to believe me, so I'm done with it.
Yeah.
No, you have to, you can live home.
Back through the state, through the pals. Yeah.
Then your go time,
That's good.
where are you gonna go? You gonna here?
Here, I'm already signed up with, the List Hamburger King. Yeah.
So. I'm just like.
Yeah.
And it's.
There was one thing that.
And it was slap in the face, right?
You, my husband's going on. After my husband has come.
It, yeah.
I've worked with
It's
this
been like a-
since she started.
And I love her. I understand she's going through a lot, so I'm not even gonna allow that.
I mean, you'll have to like,
I'm
just
just.
get the time with, get what you need, you know what I mean? 'Cause she- 24/7, but
I literally.
you couldn't have somebody better than you. I mean, her and then Adrian's there too, you know. And their infrastructure will be good for you.
She literally, her whole body was shaking up. She had.
Yeah, I mean.
And I've been. Her and. She's.
It's been helpful.
And
And
I've
even,
been just like, whatever you. I don't even know how she presented because she is so unafraid. I'm just like.
Training.
But then after this is done
You'll get lost in the weeds on
and
one thing and it's like, sometimes you just need to like have somebody there. and be
my
like,
husband's.
go get 2 more leads. You know what I mean?
Money has somebody that wants to.
I'm good.
Yeah.
Talking and doing.
Sure.
To guarantee that.
He's already pre-approved.
And after. And I'm like, I was like 70%, but.
I like most people presented, that's kind of good, don't it? You know, to give, but I'm just so, that's the thing. Good. You probably look at the guy with all the bank of it.
I guarantee these. Next 5.
I don't know, now, and Maryland may not, he's the mayor, but that's most of their. Really?
What?
2.5. Yeah. So I just have another friend of mine and he saw mine was 3.5. He said,
I have a friend who's in Virginia and they charge 7%. Virginia.
What is your experience though with NACA? Because I'm interested to hear, because everything I've ever had involved.
Finished, but I right now have like 9 clients going through the NAPA program. Because,
Cheaper rates.
the rates are cheaper and they pay all of their closing and settlement costs. So the only thing that they have to come up with is like, they need to have about 2,500 to pay their inspections and insurance. That's all they have to come up with and do some volunteer work at events. And some of my clients are Section 8, they have housing vouchers. So NACA works with them in a sense where if the state is paying part of your rent, when you get approved and get a house, the state will pay part of your mortgage for 15 years. And their mortgages are only 20-year mortgage.
Everything I've ever been involved with them, it was like somebody's NACA was falling apart. And I don't know, the guidelines aren't published. So I don't know.
Yeah, I just had my best friend. She lives in Massachusetts. She just went through NACA and bought a condo.
She did it closed?
Yeah, no problem. Yeah. She lives big. Yeah, so we're seeing, I'm actually going Saturday to one of their volunteer events. Cause trying to learn as much as I can about NACA, cause I'm thinking about becoming an advocate. Cause there's so many people. I work mainly in Baltimore City.
Oh, yeah.
So a lot of those people don't even know that they can get a house. Cause they don't know the programs that are out there and things like that. In Baltimore City.
With lack of education, right?
Well, that and advertisement. So the Baltimore City from like October, then maybe April-ish. There's so much money, so many programs. They give a lot of money to people.
We have that First National Bank of Georgia loan. They do it in Maryland, bro.
Yeah, well, if you're buying in Baltimore City, you get a lot of money. I have a client now, we go to settlement in May. She's got $28,788 from Baltimore City. The different programs. She was eligible for 3 different programs. So they're stacking. And so that's how much money she's gotten to pay her down payment and closing costs. So if what she has received pays all of that, she has money left, she can use that, like towards the down payment. Or she won't have to pay me because the seller is paying my commission. But you can use it and then whatever you don't use, of course, goes back. So there are a lot of programs. You don't have to do a whole lot. They have this thing called Live Baltimore. So they have a trolley pull. You go to that and that makes you eligible for just about everything in the city. So, and the trolley tour is, it's a big gymnasium with a bunch of community organizations in there, bankers and all kinds of, information about real estate.
Right.
And then you get on a bus and drive through certain neighborhoods, whatever neighborhood they are targeting for that month. So I think they have one in May and that's for Southwest Baltimore. And they take you through and tell you about the housing, all about the population, how many people live here, what the houses are going for, and all that kind of stuff. And they just drive through the neighborhoods. And once you do that, that makes you eligible for all of the programs they have in Baltimore City. So then you just have to, find your lender that knows how to put that paperwork.
All the nonsense.
Yeah. So
because there's a lot of like finance.
Yeah. So First Home Mortgage.
Yeah.
They are his name is Ryan. He knows all of the programs. He is the one that goes and trains the different lenders at the banks about these programs in Baltimore.
Does he do the loans?
Yes, he does loans as well.
Yeah.
He was first. So, but the young lady that I'm working with now, that, he went through Truist, because Truist, the lender there is also, very knowledgeable about all the loans, but they gave her a better interest rate and more money than First Home. So she went through there, and when you were talking about the lender, I was like, ugh. Oh boy, she drive us nuts. But when that everything got to that underwriter, like she promised me, she said, when it gets to the underwriter, it's done. I do everything that needs to be done. I research, I make sure I get everything so the underwriter doesn't have to come back with a whole lot. And she did. The only thing that he came back with, he needed a copy of the EMD. So I'm like, it's worth going through the headache, because she was driving us, she and I it's like she'll call me 8 or 9 o'clock at night. Because I'm up. I'm up working on my stuff. And we get things, and then my client, I'll call her. This is your house. If I'm up, you should be up. So I call her, hey, look, we need this, that, and the other. And she's on it. So it has worked out. That's the program. So far, the NACA piece, my people are just going through. A lot of them have done their workshop. Then they have to submit all their docs and do their counseling. So the thing that I really like about NACA is once they submit all their documents, and it goes straight to underwriting. So they're not pre-approved, they're approved.
Yeah.
So when that's done, it's like cash in hand. Go find your house. For me, I didn't become a NACA realtor, but I registered with NACA so that I can put my clients in. So they take them through all of the training and the counseling and all of that. And when they're approved, then they give them back to me so I can go and help them find a house.
You have to let me know how it goes.
Yeah.
I'd be
Yeah.
interested to find out.
Okay.
Hey, thanks, Andrew.
Yeah, for sure, man.
We'll see you around.
Yeah.
A lot, I'm sure.
For sure.
Thanks for letting me listen. I'm
Of
listening.
course. Yeah, it's just,
Any good?
it's so many, hey, I love it. It's so many, most people are working with people who can afford houses or have here or who their parents are, but
This market.
people I work
is tough.
with. Yeah, so the people I work with are people who would ordinarily be able to afford a house. But I just feel like everybody should have the opportunity to be homeowners, and that's who I work with. Housing authority people, I don't care. And NACA doesn't go based on your credit score. They're not credit score driven. They look at how you pay your bills monthly. And they do a 12-month look at how you pay your bills. And if there's some hiccup, they give you a little time to make that thing straight. So you have a lot of people who, but they don't have credit, yeah.
None of that.
And then it's this prime lending or whatever. Hey, if you can't get through, we can do this kind of lending it doesn't hit your credit score. Everyone's approved. If you have it paid off within 90 days, you only pay a $75 origination fee and that's it. If you go past 90 days, that's when they nail you. And then it's like buying furniture at Aaron's.
Yeah, my husband and I did the same thing with Value City.
Yeah.
They're gone. They've been around a very long time. Value City is gone. They're gone out of business.
So actually furniture, furniture in this area, which is still, they have a big warehouse outside of Baltimore area. Also their other one is in Philly. That guy owns, my gosh, how many different Ashley stores in 4 different states. He's the largest franchisor in the world. For Ashley. His name's Abdul.
There is one on 40 East in Baltimore. That's the one we used to go to.
That guy.
Yeah, that's one we used to go and look into. But you know what? I said, well, Ashley